2 in the morning, you're staring at a chart on your phone in the dark, a countdown $1,100 in the last 40 minutes, and you're telling yourself the same thing every losing trader has told themselves right before it got worse. I'll make it back on the next one. You will not make it back on the next one. That moment, that exact feeling is not a personal failure. It is the single most predictable moment in all of retail trading, and it happens to almost everyone who tries this on a schedule you could set a clock to. Here's the number that should stop you cold. Somewhere between 74 and 97% of retail traders lose money. Not underperform the market, lose. Real out-of-pocket, watch the number go red losses. And this isn't one sketchy study with a small sample size you can wave away. It's Brazil, it's Taiwan, it's India. It's 28 years of data from 8 million trader accounts and 295 million actual trades. It's every regulated broker in Europe legally required to publish this exact number on their own homepage in plain sight that almost nobody reads before they click deposit. Different countries, different decades, different assets. Same brutal number every single time.
So today, we're not doing trading is risky, be careful. That's true, and it's useless. We're going to open up the actual machinery, the specific structural reasons an activity that feels like a coin flip turns into a near guaranteed way to lose money for the overwhelming majority of people who try it. And at the end, I'll show you exactly what the tiny sliver of people who actually win consistently do differently, because I promise you it is not what you're picturing right now. Hey, welcome back. If you're new here, this channel is about money the way it actually shows up in your life, not the theory, the actual mechanics. And trading might be the single clearest example on this whole channel of a gap between how something feels in the moment and how it actually works over time. 4 parts today. First, the actual scale of the problem, because the number is more extreme than most people assume. Second, the quiet mechanical costs that lose money before a single trading decision even happens. Third, leverage, and why it turns small mistakes into account-ending ones. And fourth, the behavioral traps, the actual psychology that keeps smart, capable people making the same losing decisions over and over. Let's get into it. Part 1, the actual scale of the problem. Let's start with the FINRA number, since it's one of the most cited. 72% of day traders end the year with a loss. Not a slow year, not a bad year, a typical year. Now, here's where it gets worse. That's the 1-year number. Look further out and the survival rate collapses. 40% of day traders quit within their first month. Only 13% are still trading after 3 years. And of everyone who starts, only about 1% are consistently profitable over a 5-year stretch. 99 out of 100 people either quit or lose money long term. One of the most detailed studies on this, out of Brazil, tracked day traders on their local exchange over multiple years and found that only 3% were profitable at all, and just 1.1% earned more than the Brazilian minimum wage from trading. Think about that phrasing for a second. The bar wasn't got rich. The bar was earned more than minimum wage, and 99 out of 100 people didn't clear it. And this isn't unique to any one country's market structure or regulatory environment. India's securities regulator found that over 70% of intraday equity traders lost money in a recent fiscal year. And when they looked specifically at futures and options traders, the number jumped to 91%. Across Europe, brokers offering leverage trading products are required by regulation to disclose what percentage of their retail client accounts lost money. And depending on the broker, that number sits somewhere between 74 and 89%, updated quarterly, sitting right on their own homepage. Most people scroll past it.
Here's the detail that should really change how you think about this. The losses aren't random. They spike hard during exactly the moments people are most tempted to trade. One large-scale study tracking retail activity through major volatility events, market crashes, Federal Reserve meetings, interest rate shocks, found that retail traders lost money at the high end of that 74 to 89% range, specifically during those high volatility windows. The moments that feel most exciting, most urgent, most like an opportunity you can't miss, are statistically the moments retail traders get hurt worst. Part 2, the mechanical costs nobody budgets for. Before we even get into psychology, there's a purely mechanical reason trading is harder to profit from than most people expect. Every single trade has a cost attached to it before you've made a single correct or incorrect call. There's the spread, the small gap between the price you can buy at and the price you can sell at, which the broker or market maker pockets regardless of what happens next. There's commission if your broker charges one. There's slippage, the difference between the price you saw on your screen and the price you actually got filled at, which tends to get worse exactly when markets are moving fast, which is exactly when people are most likely to be trading. None of these costs care whether your trade idea was good. Now, here's where it compounds. Research from economist Terry O'Dean, one of the most cited names in this entire field, found that individual investors trade far too much for their own good, and that the specific securities they choose to sell tend to outperform the specific securities they choose to buy by more than 2 percentage points over the following year. Read that again. On average, people are selling their winners and buying their losers, and then paying transaction costs on both sides of that mistake.
Why would people trade so much if it's structurally working against them? Overconfidence is the single biggest driver academic research keeps landing on. People systematically believe they have better information, better timing, or better instincts than they actually do, and every trade feels like a chance to prove it. The problem is that more trades don't average out into better odds. They average out into more fees paid, more spread captured by someone else, and more opportunities for the same psychological mistakes to repeat. There's also a diversification problem hiding in plain sight. Odean's research found that the median individual investor holds something like 3 stocks in their account at any given time. 3! Not 30, not 300, 3! Which means the difference between a good year and a catastrophic one frequently comes down to how 1 or 2 individual bets happen to go, rather than anything resembling a diversified strategy. Concentrated bets can absolutely pay off. They can also wipe out years of gains in a single bad week. And for most people holding 3 stocks, that's a real structural risk they didn't fully price in when they made the trade.
Part 3. Leverage, the multiplier on everything. If mechanical costs are the quiet drag on returns, leverage is the mechanism that turns an ordinary bad trade into an account-ending one. Leverage lets you control a much larger position than the cash you actually have, borrowing the difference from your broker. It's genuinely useful when used with discipline. It's also, according to the data, one of the single clearest predictors of retail trading losses that exists. One widely cited dataset found that traders using margin to leverage their positions posted an average return of negative 4.53%, meaningfully worse than traders who didn't use leverage at all on comparable trades. Here's why the math works against you so specifically. Leverage doesn't just amplify your gains when you're right, it amplifies your losses at exactly the same ratio when you're wrong. And because most retail traders are wrong more often than they're right over any meaningful sample size, leverage is mathematically working against the majority of people using it more often than it's working for them. It's a multiplier applied on top of an already unfavorable base rate. And leverage interacts with the psychology in a particularly nasty way. A 10% adverse move on an unleveraged position is uncomfortable. The same 10% move on a position leveraged 5-to-1 can wipe out half your account in a single session, which triggers exactly the kind of panic that leads to the next section's problems at the worst possible moment, with real money in real time, often in a matter of minutes rather than the days or weeks a person might have to calmly reassess an unleveraged position. This is also precisely why regulators in India, Europe, and elsewhere have specifically flagged futures and options trading, the most leverage-heavy retail products, as carrying dramatically higher loss rates than plain equity trading. It's not that the underlying assets are inherently worse bets, it's that leverage takes an already difficult activity and raises the stakes on every single mistake.
Part 4. The behavioral traps. Here's the part of this that I think matters most, because it's not about knowledge or intelligence. Some of the people who lose the most money trading are objectively smart, successful people in other parts of their life. The problem isn't IQ. It's a set of very specific, very well-documented psychological patterns that trading conditions tend to trigger in almost everyone. The first is loss aversion, combined with something behavioral economists call the disposition effect, the tendency to sell winning positions too early to lock in the good feeling, while holding losing positions far too long, hoping they'll come back before you have to admit the trade was wrong. This is close to the exact opposite of what a profitable strategy requires, which generally means cutting losses quickly and letting winners run. Most people's instincts are wired to do precisely the reverse, and trading is one of the few activities where following your gut this consistently costs you real money. The second is revenge trading, the pattern of taking a loss and immediately trying to make it back with a bigger, riskier trade, driven by frustration rather than any actual analysis. This is one of the most common ways a manageable loss on a Tuesday turns into an account-ending loss by Thursday, because the trade sizing after a loss is being decided by emotion, not by any strategy the person would have designed while calm. The third is overconfidence after a winning streak, which sounds like it should be the opposite problem but tends to produce the same result.
A string of good trades convinces people their edge is bigger than it actually is, leading to larger position sizes right before the inevitable reversion, precisely when the account has the most to lose. Several of the studies we referenced earlier explicitly found that traders' worst relative losses cluster around high volatility periods, which are exactly the periods when both fear-driven revenge trading and confidence-driven overexposure tend to peak at the same time from different groups of traders for opposite psychological reasons. And underneath all three of these sits a simpler problem. Most retail traders don't have a predefined written plan for what they'll do in each scenario before they're in it. Decisions get made live, under stress, with real money on the line, which is close to the worst possible condition for good decision-making that exists in personal finance.
Part 5. What the profitable minority actually does. So what does the 1 to 3% who are consistently profitable over multiple years actually do differently? This is the part that tends to disappoint people looking for a secret, because the honest answer is almost aggressively unglamorous. They tend to risk a small fixed percentage of their account on any single trade, often under 1%, specifically so that no single bad decision, and there will always be bad decisions, can meaningfully damage the whole account. They tend to have a defined edge, a specific, testable reason they believe a trade should work, rather than a feeling or a hunch, and they track their results with enough discipline to know whether that edge is actually real over time, rather than assuming it is. They set hard limits on daily losses and actually stop trading when they hit them, removing the decision from the moment they're most likely to make it badly. And most tellingly, the profitable minority tends to trade less often, not more, which runs directly against the overconfidence-driven overtrading pattern that the data shows sinks most retail accounts. None of that is exciting. None of it looks like the version of trading that gets clipped and shared online. It's closer to running a small, disciplined business with strict risk controls than it is to the fast, adrenaline-driven picture most people have in their head when they picture a trader. And that gap between the exciting version people imagine and the boring, process-driven version that actually tends to survive is probably the single biggest reason the loss rate stays so consistently high across every country, every era, and every market this has ever been studied in.
So that's the real shape of it. Not trading is gambling, full stop, because the profitable minority proves it's not purely random. But for the overwhelming majority of people who try it the way it gets marketed online, fast, leveraged, emotional, undisciplined, the odds are close to what you'd expect from a genuinely difficult negative sum after cost activity, because that's structurally close to what it actually is. If you're trading right now or thinking about starting, the honest takeaway isn't don't. It's know which group the data says you're most likely to fall into if you trade the way most people trade, and decide deliberately whether you're willing to build the boring, disciplined version instead. If you want to follow up where I actually build out a sample risk management framework, position sizing, daily loss limits, the works, drop a comment and let me know. And if you found this useful, hit subscribe so you don't miss it. Thanks for watching. I'll see you in the next one.